didn't just take off. It's just amazing. This was such a bullish announcement that the Bank of Japan has already surrendered on its rate hikes, and it's barely above zero. The Fed is also surrendering. They're going to start cutting. Nobody is talking about that, but that is what's going to happen because rate cuts aren't going to do it. They're not going to be enough, right? Quantitative easing is going to be required and an even larger dose than before. So the balance sheet is about to go ballistic. So gold should be rising.
Peter Schiff, a well-known economist and vocal Bitcoin critic, has sharply criticized the Bank of Japan's recent decision to halt its rate hikes, cautioning that this move could lead to severe market instability and potentially trigger hyperinflation in Japan. The decision comes at a time of significant global market upheaval. Last Monday, global markets suffered a sharp downturn, with the Dow Jones Industrial Average and the S&P 500 recording their largest losses in nearly 2 years. This decline was primarily attributed to the unwinding of the Japanese yen carry trade, a strategy where investors borrow yen at low interest rates to invest in higher-yielding assets. Japan has long maintained exceptionally low interest rates, enabling investors to exploit the cheap yen by borrowing at minimal rates, converting it into higher-yield currencies, and investing in various financial assets. However, the Bank of Japan's recent decision to raise its benchmark interest rate from 1% to 2.5% on July 31st forced many investors to abandon this strategy. Schiff remarked, "The BOJ already surrendered. It's committed to not raising interest rates if the markets are unstable. Since raising rates without destabilizing markets is impossible, inflation will ravage Japan until the BOJ is forced to crash the markets by aggressively hiking rates. Central banks like the Federal Reserve are expected to follow a similar trajectory by cutting rates and potentially reverting to quantitative easing, which could substantially impact gold." Historically, gold has performed well in environments marked by rising inflation and negative real yields. With the Fed likely to ease monetary policy soon, the outlook for gold appears increasingly favorable. Despite favorable economic conditions for a gold price surge, the expected rise has yet to materialize, presenting a prime opportunity for investors. With the dollar weakening and potential quantitative easing on the horizon, gold and silver may soon experience substantial gains. We will present clips from Peter Schiff's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Didn't just take off. It's just amazing. This was such a bullish announcement that the Bank of Japan has already surrendered on its rate hikes, and it's barely above zero. The Fed is also surrendering. They're going to start cutting. But inflation is going to take off just as the economy is officially entering recession, even though we've unofficially been in it for some time. You can't imagine a more bullish environment for gold, for the mining stocks, yet gold was down last week. In the face of this, mining stocks were down. So this is just a great opportunity. You know, the dollar ended the week flat. It closed last week on a 4-month low. So the dollar didn't really bounce from there, but it is getting ready to roll over when the Fed, starts to cut, even before it cuts. And it's not just going to cut. It's going back to QE. Nobody is talking about that, but that is what's going to happen because rate cuts aren't going to do it. They're not going to be enough, right? Quantitative easing is going to be required and an even larger dose than before. So the balance sheet is about to go ballistic. So gold should be rising. And so this is an opportunity not just to buy the metals, to buy the physical gold and silver, which you should be buying. You should give the guys over at Schiff Gold a call. You should also be gobbling up these mining stocks. Again, that's where most of my personal money is. Half my personal portfolio is in gold and silver mining stocks. I expect those stocks to just explode. I think the upside potential is enormous. Not just 5 or 10 baggers, but bigger than that. Of course, there's risk, right? I mean, I've thought this for a while, but the setup is perfect. The fundamentals are perfect. And nobody is playing this trade. The hedge funds aren't there. Institutions, retail, nobody talks about it, even though it should be, right? Even though gold is still, gold's at 2430-ish. It's right near a record high. It's barely below its record high. Yet it's a contrarian investment to be bullish. That's how bearish everybody is. So it's just, to me, it's the best opportunity I've seen. So you should be buying these stocks. The Euro Pacific Gold Fund, you could buy it no load at Fidelity, Schwab, any of the big discount brokerage firms, or go to Europac.com and talk to my representatives about how to get into our fund, how to get into our separately managed accounts where we manage a portfolio. And also the Shift, my value fund now it's in the top, I think it's in the top 10%, I forget, maybe 6% year to date. But a month ago, it was near the bottom of the pack year to date. Now it's almost at the top as we're shifting into value out of all the momentum stocks that I don't own. So the strategies are really coming into play. But what's going to kick them into a higher gear is going to be the weakness in the dollar. Once the dollar really rolls over, it's a whole new ball game when it comes to international investing. And the dollar decline is way overdue, just like the gold breakout. And even though gold has moved up, right, we have hit new record highs, nobody's cared. Nobody's paid attention. And most of these gold stocks, now some of the gold stocks hit 52-week highs last week and then got slammed on that big drop on Monday. But again, I think that was just frustration because they couldn't push gold above 2,500. Well, once it gets above 2,500, it may never look back to 2,500, right? Because they just may bid it and it'll run away, given where we are right now.
The Federal Reserve is preparing to lower interest rates as soon as next month, which could offer relief to those with mortgages, credit cards, and car loans. However, the path to that decision might be rocky. A weaker than expected jobs report last Friday sparked a sell-off on Wall Street, leaving markets in a precarious position as they attempt to recover. Uncertainty looms over how aggressively the Fed will cut rates, assuming it does so when they meet in mid-September. Despite no immediate rate cut from the Fed, Peter asserts that the markets managed a partial recovery, which likely reassured policymakers that urgent intervention wasn't necessary. A key factor in this bounce back was the significant drop in short-term yields, leading investors to nearly fully anticipate a 50 basis point rate cut in September, instead of a more modest 25 basis points. While Powell had previously downplayed the chance of a cut, the probability of a September adjustment now seems almost certain, with some speculating it could happen even sooner if economic conditions warrant. Investors grew more confident, viewing the September rate cut as inevitable, reducing the uncertainty weighing on the markets.
Early that morning, so many people were coming on CNBC calling for, hey, we need an emergency rate cut. The Fed got it wrong. We need to cut. So what I was saying was going to happen the Friday before the weekend was happening on that Monday. Now, the Feds didn't come through, but I think because the markets recovered, they felt that they probably didn't have to. And one of the reasons for the recovery was yields. Short yields collapsed, and the markets began to price in a near 100% probability that we would get a cut in September of 50 basis points, not even 25 basis points. Powell brushed that off at the last press conference. But I said on my podcast that if we didn't get the emergency rate cut, we were getting a cut for sure in September. I just thought they may not even wait until September. They may have to do it sooner, and they still might, because we still have a long time between that September meeting. Bond market started to price that in, and rates went down. That helped the markets because the markets saw this, and they're like, okay, the Fed is definitely going to cut now. We no longer have that uncertainty of it's data dependent. The market now realizes that the Fed is going to move on in September no matter what. And that, I think that helped the market psychology. The market started to anticipate, okay, we dodged the bullet here. We didn't get the rate cut in July, but it's a done deal for September, so we can stop worrying about it. Now, of course, Powell would have looked a lot more prescient if he had done what I advised. Remember, on my last podcast before the Fed meeting, I said that I thought the Fed should have cut in July based on the economic data. Again, not because it's the right thing to do, but because I know what the Fed is trying to do. And I can see that the economy was weak enough that they could try to get away with a rate cut. And they can claim that, well, inflation is going to keep falling. Well, we've got to be concerned about the employment market, the economy. They missed that opportunity. But then when they did, I said, look, we're going to get a cut in September at the latest if we don't get an emergency cut before that time. So that helped the market recover. Everything recovered. Bitcoin recovered. Of course, it didn't recover everything, but it recovered. And then the markets pretty much rallied all week long, so that by the end of the week, you barely knew that we had that crash. In fact, the Dow was down on the week, only about 0.5%, maybe a little bit more than that. S&P was practically unchanged. In fact, I forget, it was down a little, up a little, but it was almost unchanged. The NASDAQ was down, I think, 0.2% after being killed, right, on Monday morning. And some of the big tech names were just, on Monday. The Russell 2000 was down about 1.4%, I think. Gold ended up settling down about $7 or $8 on the week. After all that volatility, it only closed down $7 or $8 on the week. The gold stocks, though, they got hit a bit. They were down 2% on the week, but they got shellacked on Monday. It was a great buying opportunity in those gold stocks on Monday.
Gold prices will likely surge if the Federal Reserve lowers interest rates. Historically, gold thrives in low-interest environments because lower rates reduce the opportunity cost of holding non-yielding assets like gold. As borrowing costs decrease, inflation concerns often rise, driving investors to seek gold's stability. Additionally, a weaker dollar, which usually accompanies lower rates, makes gold more attractive to foreign buyers, further boosting its demand and price. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.